Hi, everyone. Mark Yestro here with Bridgeport Asset Management. I'm joined by my colleagues Boyan Lepoev, John Fisher, and Ian Hardacre. Here to do a little bit of a recap of 2023 and what we learned. Lots of things held true, and there's also some lessons that we can take away, and also a look forward to 2024. So, John, what do you have to say? What did we take away from
Sure.
2023?
I don't mind starting off. Overall, I'd say 2023 was a super interesting year in a bunch of different ways. First off, I'd say in a lot of respects, it was almost sort of a mirror image of 2022, particularly as it relates to the stock market. I mean, 2022, dialing things back here, I guess about 13 months now, 2022 was a really, hard year for the stock market. It was also a bad year for the bond market. S&P 500 lost about 18% of its value. Most bonds were down 10, 15, 20% if you look at the broader bond market. So it was a really sort of tough year. And as we'd say, in the investment business, there was really no place to hide in terms of public markets. People lost money everywhere. The worst parts of the market were, the big cap tech stocks, the names like Microsoft, Google, all of those stocks that had really done well over the prior several years lost a lot of money in 2022 as interest rates were sort of rising. It really took the air out of that sort of part of the stock market. Well, 2023 really shocked everyone because at the start of 2023, people thought that trend would largely continue. I don't think there was a lot of high hopes for the stock market. There certainly wasn't a lot of high hopes for, the big tech-oriented names. And it was actually those big tech names that really carried the market forward in 2023. And they completely sort of rebounded versus 2022. Overall, equity markets were strong in 2023. The bond market came back nicely as well, sort of depending what segment of the bond market we're talking about. Bonds were sort of largely up 5 to 10% over the year. But it also proves something, which is a fairly bumpy year. We're talking about returns over the entire year. But really, when you break it down into quarters or on a month-by-month basis, there was a lot of ups and downs. And in fact, it was one of those years where we sort of say, like, time, in the market versus trying to time the market was really important. I mean, unless you're a genius and we're able to time things month by month, we got most of our kind of overall investment returns in the months of November as well as December. So almost the entire year's worth of returns in most of our market segments, at least on sort of the public side of things, meaning stocks and bonds, most of the sort of returns came in the last 60 days of the year. So if you threw in the towel in September because you didn't think you were making any money and things weren't going well and you're tired of the ups and downs of stocks and bonds, you were actually really sort of lost out because things started to rebound in the last couple months of the year, and there's a bunch of reasons for that. But anyway, it was interesting overall.
Yeah, I mean, if I'd add to that, I mean, if you look at 2023, just a few points. I mean, when it went into the year, performance was quite strong, and then we had the regional bank crisis, or mini crisis that at the time seemed like a larger crisis, where we had two banks go down. So that was quite a bit, and then we had Credit Suisse have to merge with UBS, government sponsored. It was really also about rates as we went into the middle of the year. The Fed fund rate, U.S. government, was the last increase in rates. We went to the fall, and in the fall we had the 10-year government bond go the highest since 2007. But, as John pointed out, as we hit November, December, it was talking about interest rates coming down, and then the equity markets took off. So that was really 2023 in a nutshell.
Yeah, I mean, I actually find it really interesting that in Q1 2023, at the start of the year, everything was about this regional banking crisis. People felt that there was the possibility it might spread. There was a lot of doom and gloom. And here we are 12 months later, and no one's really talking about it. It's not really sort of a market factor at this point. There's still some chatter about it, but it really dominated the news. And here we are 12 months later, and it's just not even really being talked about. It's in the rear view mirror. And it kind of goes to show you how news in the moment can become overwhelming for people that, are invested in the market, but you sort of look forward 6, 12, 18 months and it's not really an issue anymore. And it's just, I think, a good lesson not to get, overly exuberant or overly panicky about the news of the day.
And I would add to that, in the funds, the regional banking crisis provided opportunities for us to add new stocks into the fund that were not necessarily financials, because the whole market came off. So that was, we use that provide that as an opportunity, and some of those stocks had great performance last year through our 3 public equity funds.
Yeah, there's no argument that interest rates certainly dominated the news throughout 2023. And myself here at Bridgeport, being on the client-facing side, I have to say that it remains a concern, but the concern now is when are they going to drop? And certainly here, I can attest that we're not in the business of making predictions or things like that. But for the sake of our clients, if we were, where would you think interest rates will be at the end of 2024?
I guess I have to take this
Sure,
question.
yeah, we'll pass it over to you. You're on the hot seat, Boyan.
It is difficult to answer, and we certainly try not to make any predictions. But it seems like the market did get over optimistic in that last quarter of 2023, when participants came in force with large amounts of capital and bid up prices for bonds and general fixed income, which compressed the amount of income, the yield that these instruments produce. And so it feels a little bit overdone when we compare to the real economy and the fact that it is moving along. However, that quantum of good news versus bad news is not exactly tilted in favor for the optimists yet. And to that extent, it appears that bond prices already factor a full 100 basis points, so 1 full percentage point rate cut by central bankers in U.S. specifically, but to some extent as well in Canada, and starting in April throughout for the entire year, right? And so we feel that this is a bit aggressive. There are longer-term effects of inflation that we feel may continue to reverberate through the economy. Ian?
Yeah, no, I agree. I mean, I think the central banks really want to squash out inflation. So there's a school of thought that we're going to see interest rate decreases early on in this year. And, my feeling's been for a while, and I think we all agree that it's going to take longer. We may not get that, 100 basis point drop. And if we do, it'll be all back end loaded, because they don't want to, central banks, Bank of Canada, et cetera, don't want to take the chance of having inflation come back at them. So I think people are somewhat overly optimistic about how quickly we'll see rate decreases. And quite honestly, in my opinion, having interest rates plus or minus 50 basis points here, 0.5%, is normal. Like lower rates that we had after we came out of COVID really, is an anomaly for the most part.
I think there's certainly a lot of people out there we see on the client side of things, that are borrowing money, whether it's for various real estate projects, whether it's, they have a mortgage for their house that are basically financing variable, and they're pretty focused on when these rates are going to come down. And I guess sort of the question for people is there going to be a lot of relief there? And it sounds like there's going to be some by the end of the year, but perhaps not as much as people are hoping for on that side of things.
And if we do get, over the next 12 to 18 months, a significant drop in interest rates, it's because the economy is not doing well. So you don't really want that. I mean, I could see 50, 0.5% or 0.75% maybe, but, if it's much more than that, it's because we've hit a recession, which is we don't want that either, right?
Yeah. Around the water cooler, I have to admit, I heard you talking about how wage inflation factors in. That was a really interesting point.
Yeah, no, for sure. I mean, I don't think we've seen wage inflation yet. That, we've seen inflation in goods, but there's a lag period for employees getting increases. We've started to see it with the auto workers where they didn't get wage increases for a long time and they got a significant one. So I don't think that's gone through the system yet, and sort of the economic system. So I think we still need to see that, and if we continue to see that, it means inflation could be stickier or hang around longer than people think.
Yeah, I mean, and a huge chunk of the consumer price index, is also housing, whether it's sort of mortgage costs or sort of rental costs for people that are renting. And as everyone knows, I mean, here in Canada, those costs are, sort of spiraling out of control. And so until we get that under control, there is a huge component of that consumer price increase that, will be driving inflation up. And it's somewhat circular. We've raised rates in order to cool off the economy and sort of reduce inflation. But at the same time, when you raise those rates, there's a component of the CPI index that just goes up. So it's sort of, it's kind of a circular kind of thing that they need to get under control.
So some of the lessons that we learned in 2023 and for the last few decades of sort of being in the industry, what can we continue to just reinforce with our clients and just continue to stay the course, right?
Well, I'll start off. I'll let these guys talk about our individual portfolios, but just overall, as I said earlier, I think it's really important to have a balanced portfolio with a lot of different legs to the stool in terms of asset mix. So, having healthy allocations to stocks, bonds, in addition to various private asset categories. So, I mean, as everyone knows, that's really our thing here at Bridgeport. We're trying to replicate a more institutional asset mix, so-called endowment model, where you sort of have all of those different portfolio mix components: stocks, bonds, private real estate, private equity, venture capital, different lending strategies, infrastructure. We think that's going to be really, really important going forward, just to try to earn stable kind of rates of return. The other thing I think we've seen is it's important to, stick with your asset mix because things shift very rapidly. Again, we saw that 2022 versus 2023. We also saw that just, interquarter, sort of intermonth during 2023. Like if you missed sort of the last couple months of the year, you were out a lot of money. So I think that's important, but I'll let these guys talk about the individual funds and what we see going forward there.
Yeah, I mean, in terms of our 3 straight public equity funds, we were very happy with the performance last year. Just to talk about that, they were all up mid-teens % return. So we're quite happy with that. As most people know, they're 20 to 25 stocks, concentrated, but diversified by business line. I mean, as we look out for each of them going for a year, we're optimistic. I'm constructive on the equity markets going out. I think we can have good returns this year. I'm not sure if they'll be quite the same returns as last year, but when I look at each individual fund and look at it per business that we're invested in, I think the risk return is definitely in our favor. All the companies generate a lot of free cash flow, so excess cash flow that they can use for a number of different areas, and we are finding new ideas as well. I think there'll be some volatility this year, but the volatility will provide opportunities for us to find new ideas, especially companies that we've done our homework on and we're waiting to buy them at the right price. So the U.S. fund, the Canadian fund, and the small mid-cap fund, I feel very strongly about all 3.
And then on the public income funds, we find that yields remain elevated than long-term sort of historical. So our securities, our bonds are producing more income in the form of yield than the longer-term average. Also, on average, they tend to be priced below their maturity value, below par, or $100 per bond. And so to that extent, as these securities come to their maturity, which is natural, they have set maturity, we expect to generate additional sort of gain. And so we're fairly optimistic, but we do try to control for duration risk to limit our exposure to interest rates blowing out even higher. and we underwrite every single security so that we can get behind the credit risk of the borrowers themselves to that extent. And we do like, again, the yield seems to be higher than the long-term average, but we are approaching cautiously because if the economy slows down, bond markets, just like equity markets, will take a little bit of a dip. On the private side, these three funds that we have, one focused on private credit and various income strategies, the other focused on private equity and venture to a lesser extent, and the third focused on real estate and real assets. They're very different. In those funds, we make longer-term investments. These are typically commitments to dedicated funds with specialist managers. So we spend a lot of time trying to understand how the strategy would work, who is the manager, the sponsor behind these strategies, and the people involved, and can they do it? Does it make sense that there should be that opportunity to earn that extent of return over a period of time? And we try to diversify quite aggressively in those funds, as these are, again, longer-term commitments that we need to be okay with several years from now.
I mean, I don't think we want to make any stock market or bond market or private asset predictions.
Or interest rate.
Or interest rate predictions for the year ahead, but maybe just because we're coming up to Super Bowl Sunday, does anyone have any kind of predictions for who's going to win the Super Bowl?
You gotta go Mahomes. You gotta go.
Yeah, well, I think the NFL would probably want Kansas City to win with all the hoop around it, but like I think San Francisco is a better team, so I'm going to take San Francisco.
Okay, Ian's
KC.
San Fran.
Yeah, I gotta go with Mahomes.
Mark's KC.
He's going for Brady's record.
You know what? I will say that I'm looking forward to watching the Usher show. But yes, Kansas should be.
Kansas City.
Kansas City.
All right, we'll see you next week.
Yeah.
3 versus 1.
3 versus 1. We'll have to regroup.
All right. Thanks, everyone. If you haven't, please feel free to leave your comments, concerns on our website. Feel free to contact us. The information's there. And thanks for joining us.